Good day, fellow investors. Great comment here asking what kind of buy is Amazon now, as all the great value investors from Druckenmiller, Klarman, Ekman have bought and initiated significant portfolio positions in Amazon. Let's discuss what's going on and end up with something surprising. Will I buy Amazon? If we look at the company over 1 year, the stock has done nothing, 1%, but Amazon kept on growing, kept on investing, kept on building, and now more and more investors have piled into the long-term Amazon story, while short-term investors are selling the AI capex threat. And the last time we discussed Amazon as a buy was a few years ago when the stock was at 90. I told you 2x potential upside, 30% risk downside, and that is what happened. We are now a little bit more than 2x. Just for context, my name is Sven. I have a value investing research platform where we focus on investments that offer a margin of safety, sure, long-term profitability, a long-term runway, a moat hopefully at a fair price. Let's see if Amazon fits that scenario at the moment, as I just updated on 2 stocks on my research platform that do fit those requirements. So when it comes to Amazon, most of the purchases that we discussed happened in the last quarter here. The stock is now lower. That means that we can buy it below the prices that some of these investors paid. Druckenmiller increased the position, Klarman started the position, Ekman also increased the position despite buying most of it during Liberation Day. Buffett bought earlier, it's likely Ted, but he bought and now already slashed the position. You never know what Berkshire is doing. But let's look at Bill Ackman's explanation, as he has clearly put it into his presentation. Largest cloud business by market share, secular IT infrastructure and process tailwinds, long-term dominant retail e-commerce operator. And he has put 14% of capital there because Amazon value investing is now at the lowest P/E ratio over the last lots of years, likely since ever. And when you look at what it offers, as already said, e-commerce business continues to grow. AI investments at scale, but Amazon is investing in AWS, which will bring the infrastructure to the systems, and they are not investing on a bet. The recent 200 billion capex is already booked. They are investing on demand that they have on their customers. And I've seen this, my research platform also runs on AWS, and over the last few months there have been some glitches here and there, which means Amazon needs to invest more to custom for all the new customers, the new capacity, and eliminate those glitches. Don't worry, 99-point-something% uptime, but still there is something happening or servers not working there, things like that. So revenue keeps on growing, but that is overshadowed by higher than expected capex guidance. When we look at Amazon, what is moving? AWS is re-accelerating after a little bit of a slowdown spending plan because they can't meet demand. And then we have also the hidden place. The Amazon chips, Nvidia is booming, Amazon is also doing their own, and also advertising. If we look at the latest numbers, still great, 12% growth, operating income 17% growth, segment results, AWS 24% growth, high operating income, that's 30-something% margin, that's great. The cash flows are logically going down because they have decided to invest to meet up with that demand. Long term, they will optimize those free cash flows, and when they optimize those free cash flows, let's say the operating cash flows keep on growing, and let's say they hit 250 in 5 years, the capex will not be 120 billion constantly, maybe will fall to 70, And there you have 180 billion of profits that would justify the current valuation. So that is what the big investors are likely looking at, not next year, next 12 months, but the long term of Amazon and the optionality there in the two businesses that are driving growth. So, despite free cash flow going into negative for a while, which is standard Amazon practice, this is a growth at a reasonable price situation. If the 10 to 15% growth continues, the PE ratio of 25 is really cheap, and that should bear fruit down the road. Now, in our intrinsic value discussion a few days ago on the Mag 7, I have analyzed Amazon, so let's just take a look. It was the cheapest of the Mag 7, but perhaps I have been a little bit too conservative on the situation. I have to put 2026. Earnings per share now is 7.17, and now we have to look at the growth there. I have put 8%, which is still good, but not as good as Amazon could do. If I put 15% growth rates and then let's say it drops down to 10% going forward, if I expect a 10% discount rate, P/E ratio goes down to 20, the intrinsic value is 179, 180, not far from the current stock price. Thus, if I just expect a 9% return long term or 8, that's a good return. And for the billions that investors are having, that's not a bad return. Plus, if you look, okay, we are now priced at an 8% return, but most of the market is priced at a 4% return, which means that if Amazon situation happens faster than just the educational intrinsic value template that we use there, it happens in 3 years, then it means you have a 50% return in 2-3 years. That's what, 15-20% per year. And perhaps that is why, especially Druckenmiller and even Ackman, I think, are buying. Claremont also deploying the cash, the availability he has into situations that are low risk, good reward. As Amazon keeps on developing, I would not be surprised for this to hit 3 trillion, 3 something, on 150 net income down the road, but that 150 net income doesn't have to be achieved immediately. If the market starts to think next year that they will hit it 3 years down the road, then that will be repriced. So Amazon is not priced as the market is priced at an 8-9% return likely, and that is why they are buying. So the 2030 scenario, upside significant, little downside because Amazon will deliver on those numbers, perhaps a little bit less if there is a recession, perhaps a little bit more if not, if there is success or something like that. And that is the upside. The positive return is likely there, but it's uncertain when and how. Long-term investors or smart investors are piling in. In that line, I have also put Amazon a little bit more exuberant. I have put it at an 8% likely return in line with what Claremont is doing, and then it can even be better. Therefore, the conclusion is, given the situation, given the big guys buying it, it's not a bad addition to a portfolio now, depending on how diversified you are. Will I buy it? If we look at the positives, there is growth, there is flows, which we'll discuss tomorrow, still coming into the AI, Mag 7, people are buying it globally, thus pushing stock price higher. The stock is relatively cheap compared to others, because others aren't growing at 14% and have a P ratio of 30, this has 25. It is a great business. It is an essential business now in the cloud AWS sector. It was my mistake in 2023. I had to dip a little bit on that situation because I knew that I could not lose money, because I knew that Amazon at 1 trillion was a bargain. But okay, that's now past. Will I buy it now? Let's first discuss my portfolios. For my personal portfolio, no, because I have better. In the model portfolio, I have 5% cash, and I'm leaving that for wow situations. So if Amazon goes even lower and then it might become a wow situation that would make it interesting. With the diversified portfolio, I'm researching a lot of stuff now, so what would be the added value there? Because that's a portfolio where I look at things, watch things. Perhaps it could be interesting to just add there something as a step into also buying growth at the right price. The negatives, why would I wait, is US market share of the global world. Because the global world is global, you can buy things from China, from the Amazon, from this, from that, and the US market has 63% of market share. I think that over time will mean revert to the 50s somewhere, and therefore that is a weight on Amazon. I'm not afraid of the CapEx spending because if it doesn't turn out, they will lower it down. They're highly profitable. But also when it comes to relative valuations, I prefer absolute valuation and not relative. P ratio 25 is good. P ratio of 18, 17 would be an absolute steal for Amazon. So just a perspective situation. Every time I also do a video like this, it helps me think about what to do, when to do. I'll put it somewhere on a list and then see also when I analyze my diversified portfolio, when I update it, I think in March, and then we'll see whether Amazon might fit that portfolio. Thanks for watching, very interesting. Let me know in the comments whether you are adding this to your portfolio.